Good afternoon, everyone, and welcome to the Pinnacle Institute's YouTube session on stocks. I'm Bill Nelson, your host for today's session, and also one of our specialists on staff. For me, I host our weekly webinar on investing stock picks and related strategies. I also teach many of our courses here at Pinnacle, from stocks and futures to the spot foreign exchange markets, also known as forex. Nice to be with you, and plenty of things I'd like to cover in our session this afternoon. Hope you're having a wonderful Friday. First thing, though, is we have coming up several workshops for you to understand more about the Pinnacle method and what we are about. And overall, our objective is to help you and our members take control of their investing portfolio and learn more about how the financial markets really work, and using that to our advantage. So if you're new to trading and investing, I invite you to watch my good friend Steve Moses coming up next week, Tuesday, July 13th at 11 a.m. Eastern Time, as well as then a week later, Tuesday, July 20th, same time slot, where if you are new to trading and investing, or actually unfamiliar with our approach to the financial markets, which is supply and demand, which we're going to talk about a little bit today, as a matter of fact, tune in to Steve. If for many of you who are not only just aware of maybe the Pinnacle method, but more importantly, how supply and demand works in the financial markets, we have some advanced workshops led by the founder of our supply and demand strategy, Sam Seiden, and those are coming up next week, Wednesday at 11 a.m. and then Saturday, Saturday, July 17th at 10 a.m. So mark your calendars for those, and to sign up or become aware of or get the links for those events, go to pinnacleinstitute.com/upcoming events. So hope to see many of you there, and I'm sure I'm very confident you'll find those sessions very valuable. I should point out, those are free. So anyway, look into those, and if they fit your schedule, we'd love to see you aboard and get a little more of an insight in terms of what we are about. So as we go through today, oops, sorry about that. Let me get back at it. Just stand by. I don't know why my screen went dead. Current slide. All right. Would you believe this never happens to me? All right. There we go. Share screens. Yeah, I don't know why there we go. I don't know why my PowerPoint went to the very end. Okay, so before we go any further, let's talk about disclosures. And that is, as we go through today's presentation, let's bear in mind that you agree that all trading comes with risk, and you also acknowledge that all products and services offered that we offer do not come with a guarantee of success. The Pinnacle Institute does not make any money market claims, and any analysis given is no guarantee of success in the stock market. Any of the material we cover is copyrighted, and so we don't want to see it elsewhere on the internet. It is purely for educational purposes only. Okay. And we follow the Federal Trade Commission guidelines that specifically relate to money making claims. And to the degree that there are any money making claims made in this presentation or any presentation of the Pinnacle Institute, we require that there be documentation supporting such money making claims. So that shouldn't be the case in today's presentation, but just want to make that very clear. Okay. All right. So as we start off, what is the governing factor in every single market and not just stocks? Maybe the gold market, the oil market, or agricultural products, or in this case, wheat. The one governing factor in every single market, not just stocks, is what, everyone? Supply and demand. And let's look at this chart on Tesla very specifically. What we can see is a huge run-up in price in the share price of Tesla. The single share price got as high as 900 or over 900. So we'll call it 975 from around a base area of $100 per share. And what this all means, and the reason or the outcome of the increase in price of shares of Tesla, is that more people want to buy Tesla shares, but there's a finite supply. And that's true with any publicly held company we can find on the stock market. There's a set number of shares. And the more people that want to buy those shares, the more expensive or the more value each of those shares becomes. And that is the case in Tesla. So when we have more buyers, meaning demand, it pushes price up. And we can see that even on this chart, just lightly at 975, the last buy order, the last little bit of demand got filled. And then what happened, of course, we saw supply take over and we had greater supply than demand, and that pushes price downward. What we do here at Pinnacle is use that same concept of supply and demand that occurs in every other market, and we apply it in any other market, and we apply it to the financial markets. So how do we make money in the stock market? Obviously, we buy here and sell here. Another way of looking at it is that we look to buy on sale. So, and so just to recap a little bit, so regardless of our objective, whether we are investing or trading for income, the only way to make money in the stock market is to buy stocks when they are on sale. Now, for many of you who are very aware of how the financial markets work, we can do something called shorting, but that's outside the scope of what I want to talk about today. So let's just talk about the traditional way that we can make money in the financial markets. And that is we buy at a lower price and exit our position at a profitable higher price. Okay. So that is the theme, and that is the theme of everything we do here at Pinnacle. The stock market, I just kind of just go off the slide for a second. The stock market is the only market where people are willing to buy Tesla here at $800 a share after the huge run up in price. This is very similar to walking into our car dealer and them telling you that the Honda CRX that you're interested in is, they give you the price and you're willing to even pay a higher price for that car because somewhere on the line you think that that Honda CRV is going to be higher in price and you're willing to pay the highest possible price for it, think it's going to go up in value. I mean, it's like idiotic. We would never do that, right? And yet this is what many people and especially in the retail side of things, do in the stock market. They will buy at the highest possible price, thinking that the price is going to go further without any thought that banks and institutions, or just the mere fact that anyone who bought Tesla here at $100 a share will be exiting Tesla at a given price point that is much, much higher. And it is typically after a major run in price. And we've seen that now in Tesla. Some people are unloading their Tesla shares, and less people are interested in buying, which explains the decline. Okay? Hope that makes sense to everybody. So our theme today is zeroing in on bargains in the stock market and using a couple of terms called growth stocks versus value stocks. But within the plethora of stock market vocabulary, there are so many terms, from what a mega cap is, a large cap company, small cap, ETFs, mutual funds, a concept called earnings before interest, taxes and depreciation. That's EBITDA, return on capital. But what we're focusing on today is just a couple: the growth stocks and value stocks, okay? And the concepts behind each of those. What are growth stocks? Those are companies that are expected to outperform the market. The ones that come to mind, there are many out there, but the ones that come to mind that we're all familiar with are the FANG stocks, specifically Amazon, Google, Tesla, which we've seen the chart already, Facebook, and Netflix is missing from this area. But there are so many other growth-oriented stocks. And what does it mean? It means that these companies are expected to outperform the market. What is the market, you may ask? The overall market is actually something that we refer to as the SPY. This is an ETF that you can buy virtually through any broker. It's called SPY, and it is a collection of the 500 best companies, if you will, determined by the Spider Select company from around the world, that they themselves represent a decent, a very good investment opportunity. They do the research on thousands of companies and select 500 to be part of the club called the SPY. A couple of times a year, they kick out the underperformers and take in new companies. So overall, the design of the SPY is in fact to go up over time. And then, of course, we see some corrections that occur in the market. And when those corrections occur is when, of course, we should be buyers, and then sell, when either price reaches our price target, or at some point where we have determined we want to take those profits and redeploy them or use them for other purposes. So growth companies are expected to outperform the SPY. And that's what would be classified as a growth stock. You can do your independent research across the board, on the internet in terms of what are classified as growth stocks. But today I want to talk a little bit more about a value stock and compare the two, okay? So what are value stocks? Value stocks are companies that have share prices currently below what the company may be worth when we apply some standard valuation techniques to looking at the company. So what would cause a company to be trading at prices below what it's worth? Well, first and foremost is perception. One, the company can be out of favor. Maybe it missed earnings estimates. And with publicly held companies, we get 4 opportunities a year where we can trade companies where if they miss earnings and their price drops because Wall Street no longer thinks the company is in a position to meet the various earnings estimate, we'll see a price decline. Or potentially the entire industry is out of favor. We saw this with the cruise lines right during the COVID crisis of 2020. This represents actually just a couple of weeks here in March of 2020, where we saw the cruise lines face a serious decline. This first chart is Carnival Cruise Lines. The second is Royal Caribbean. And then it's been a slow, Royal Caribbean has come back maybe about 50% in terms of its low following the COVID crisis. And Carnival is still inching its way back, going forward. But the entire industry was deemed to be out of favor. Maybe some were saying the cruise industry will never come back. Well, we see that there is some recovery there. Continuing on, the airline stocks, very, very similar, right? The airlines travel, international travel and domestic travel, virtually within any developed country around the world, came to a sudden halt beginning in March of 2020. And that sudden decline in business was directly reflected in the share price of these companies. Delta Airlines, again, has come back probably more than 50%, at least at this point, and maybe now it's sitting at 50% recovery from its COVID lows. But again, this is just to explain what the kinds of value stock companies we can find in the stock market, okay? And it's not just, we don't necessarily need a crisis. Again, it could be one singular company missing, missing earnings. Southwest Airlines, similar picture. And of course, it has, did recover close to its pre-COVID highs. But in any case, now seeing a little bit of a correction. And what does this all mean, ladies and gentlemen? It means that banks and institutions, and we'll say some individuals, once price hit a low where the last sell order was filled here at around $20 a share on Southwest, what occurred in the market was the fact that institutions began buying up many of these stocks. When we say institutions, either banks, pension funds, whoever it may be, saw that picking up Southwest here at a bargain was well worth the effort, and they were not ready to give up on the airline industry. And the same could be said of the cruise industry as well. So we've talked about what value stocks are, companies with share prices currently below what the company is worth, and we apply some techniques to that. So essentially, value stocks are bargains. And when we focus on value stocks, it's helping us determine buying a given stock when it's on sale with an expectation that price will go back up. We've talked about perception, and then we talked about the fundamental analysis. So let's talk about fundamental analysis, applying it to value stocks. And I ran a screener here, and this is just some high level criteria. For those of you that are new to stocks and investing, you could go to virtually any third-party website, whether it's Bloomberg, the Wall Street Journal, CNBC, the London Times, whatever it may be, wherever you are in the world, any of the business publication that is popular in your country, in your home country, will probably have a screener, or you can use some of these US or UK based screeners as well. So just click on tools, stock screener, whatever it may be, and you'll have some fields here that you can fill in. And that's what I did earlier in the week in advance of this presentation. So I ran a screener, and quite simply, all I did was pick large cap companies and over large cap companies. And these are companies, when you add up market capitalization, ladies and gentlemen, is simply this. When you add up the price of every share or excuse me, it is the share price times the number of total shares that are outstanding in a given company gives you the market capitalization for that company. So companies that have relatively small number of shares available, and then also those share prices are relatively lower than other companies in the market, that's where we get medium cap or small cap kinds of companies. Market cap is just one way of looking at large and the super large companies over time. Okay. Price earnings, the price earnings ratio. And that is the stock price divided by the earnings per share price that is expected. Okay. So these are a couple of, they might seem a little esoteric, but they're just very, very high level valuation terms that stock analysts use in beginning their analysis of looking at a company on whether the current price is cheap, or whether it's a bargain or it's expensive. The price to book ratio. This is the share price compared to the value of the assets that a company has on hand. Okay. And then I also was looking at companies that were paying a dividend. Generally, one philosophy we have here at the Pinnacle Institute is that companies that pay dividends, regardless of how big or small the dividend may be, but companies that have paid dividends for years upon years upon years are companies that certainly respect shareholder value, and therefore have a management team in place that take the share price of the company very, very seriously and are dedicated to returning to shareholders a return on their investment. And one way companies do that, the greatest way, is through price appreciation, right? Buying Tesla at $100 a share and then getting out at $900 a share is incredible price appreciation. But over time, companies that return a portion of their profits called dividends back to shareholders is another way of respecting shareholder value. Okay, so these are just a few of the dozen of inputs we could add to a screener, and then you hit submit, and then whatever screener you're using will produce a list for you. Again, these are just high-level results, and they require further diligence on each of our parts to determine whether any of these companies that are listed meet your objectives, in terms of companies that you're interested in holding either for the short term or for the long term. So just the fact that I put the results of a screener here is not an endorsement by the Pinnacle Institute that these companies themselves are worth your investment. So do your homework and investigate the results of this on your own. Okay, but this is just the results of our high level, screener. I just want to point out, though, as you can see, the results of using these inputs gave me a number of results in the financial sector. And so this is a little bit of a red flag just on my own, that I don't want to have a portfolio that is tied to the entire banking sector. So that's just one little yellow flag that I wanted to point out for you. But it's why I ran a different screener. So I went to a different, and again, it's not an endorsement of investing.com. There's just one of dozens of screener tools out there that you can use. But here are the inputs that I used. And instead of a dividend yield of 2% or more, I started at 1.5%. And so just giving us a little more breathing room in terms of the kinds of companies that might fall into the category of value stocks. Okay. And again, these are just high level results. You have to determine for yourself whether any of these stocks meet your specific criteria of something you want to own. But now, by just changing the dividend component, instead of just 20 results that are basically banking and insurance companies, we've got a wider variety of companies to choose from and to determine, potentially looking at the price chart or other components, maybe doing your own research on each of these companies, potentially just checking news articles and seeing what maybe other experts are saying about each of these companies. Within Pinnacle, we go directly to the price chart, and we'll get into that. Okay, but here's the results of the second screener that I did, and it came up with a very reasonable list of 61 companies, 61 out of almost 14,000 stocks. Okay, so even if you're new to investing, using a screener is a great way to begin to narrow down your search in terms of companies that you're interested in. And I just gave you a handful of criteria you might want to consider. Again, several other options that you can play around, and and then just examine the results of each time you run the screener. Okay. So the one component that I want to get across to all of you is that even growth stocks can be value stocks when applying the supply and demand methodology we use here at Pinnacle Institute, such as identifying. So what we do is on a daily basis, we provide stock picks and future picks to our members. But more importantly, along the way, we help our members identify high quality and highly probable turning points in the stock market that they can apply themselves on any stock that they're looking at, and determine by looking at the stock chart whether it's an opportunity that fits their criteria after learning what the Pinnacle method is all about. So here at Tesla, instead of buying Tesla here at $900 a share, hoping it's going to go higher, our approach at the market, our approach to the financial markets and to any stock, any futures product, any foreign exchange pair that we could be looking at, is to determine where is the high quality turning point. In this case, we identified this area. After watching this move, we determined that this area would be a high quality turning point. And in fact, it was. Price came back and at least got 3 or 4 to 1 risk reward ratio in terms of our entry, to even just getting up to $800 a share. So being able to buy Tesla at $570 and getting out at $800 a share, that alone represents a nice return. And again, we also have offer criteria for determining when and where is an opportune time to take profit. That was Tesla, a growth stock. Again, let's look at a different growth stock, Facebook. Again, using our criteria and in looking at the $300 a share price, when price returned back to 300 after leaving the zone and coming back, Facebook continued on its trajectory up to some new highs. And I think anyone would agree, being able to buy a $350 stock at $300 represents a pretty significant sale price, or a pretty significant bargain for on Facebook. And that's what we're doing. This is the entire approach of the Pinnacle method to identify these high turning points. And again, I'm only using the stock market in terms of buying at a bargain and getting out at a target. We do look at the charts in an opposite way, where selling has occurred and price dropped, looking at those opportunities as well. But again, we'll save that for another time. So here's Netflix. Once again, just following the mindset of, today, at least helping you understand, when you hear the terms growth stocks and value stocks, you'll understand what they are. Value stocks really are referring to bargains, companies that have share prices that are below what it's actually worth. And those may represent an opportunity. But growth stocks themselves can represent an opportunity when we're looking to buy them on sale. And here's the case on Netflix. Having watched a very significant move away from the $450 area on Netflix, and then having in place the interest in picking up Netflix again when it returned to the same area, and then watching it go back up to new highs. Okay. And it's our approach to the charts that give us that laser sharp focus of looking at these high quality opportunities that also represent high probability and high reward. Okay. And of course, we can apply the concept of value to value stocks. And what do we mean by that? We mean that in the case of Intel, a company that did show up on the screener, looking at an opportunity where you can actually buy a value stock that in and of itself is classified as a bargain, but instead of buying Intel at $66 a share, how great is it to identify an opportunity in advance and on a $68 stock, being able to buy it at $53.50? And that's the approach that we use in the stock market. Okay. We are all about looking at bargains in the financial markets and then applying our methodology, which we can apply across the board, whether it's stocks, futures, or the spot forex market. And then by using this knowledge, it also helps us to make option trades that have higher probability related to them, just based on how we look at the charts. So that is the presentation that I have for you. And I just wanted to remind all of you of our upcoming sessions. Again, these are free to anyone who signs up in advance. So we have a couple next week. Whether you are new to trading and investing, or you are experienced in trading and investing, and especially have an exposure to our supply and demand strategy already, check out both Steve and Sam's sessions next week and the week after. So, and then with that, do reach out to us if you have any questions about today's presentation. Do reach out to us through the pinnacleinstitute.com website. And if it's specifically related to anything that I covered, that email will be forwarded to me, and I'd be happy to respond to any of you with questions about what we've covered. So in essence, we talked about growth stocks and value stocks, how both can be bargains when we apply supply and demand to the stock charts. Okay. Thank you, everyone. Hope you all have a great weekend and a great week ahead. So long.